You ever notice how the biggest financial institutions, banks, hedge funds, billion-dollar firms always seem to win, even when the market crashes? It's like they're playing a totally different game from the rest of us. The truth is, they are. And today, I'm about to break down the hidden bank strategy that these massive firms use inside the crypto world, so you can understand it and even start applying it yourself. Let's start with something most retail investors never think about. Banks don't just buy and hold assets. They leverage, they recycle capital, and they earn yield even on what looks like idle money. That's the mindset you need to start adopting in crypto. Because, while retail investors chase quick flips and meme coins, institutions quietly build income streams that never stop producing cash flow, no matter what Bitcoin's price is doing. Think about this. When a traditional bank gives out a loan, they're not using their own cash. They're leveraging deposits, earning interest, and turning every single dollar into multiple streams of profit. Now, imagine that same strategy applied to crypto. Instead of lending out dollars, these firms are lending out stablecoins, staking assets, farming yield, and using derivatives to hedge their downside. They never let their money sit idle. One of the most interesting things I've seen is how firms like Galaxy Digital, ARK Invest, and Grayscale operate. They build portfolios that look diversified, but underneath, it's all structured for liquidity recycling. Meaning, they might stake Ethereum to earn yield, use that staked ETH as collateral to borrow more stablecoins, and then redeploy those coins into short-term yield vaults. It's like having $1 working in 5 different places at once. Now, the average investor doesn't have access to institutional-grade tools. But the truth is, today, crypto is leveling the playing field. Platforms like Aave, Compound, and Pendle Finance are letting anyone do what banks have done for decades: borrow against their own assets, earn interest on collateral, and build layered income streams. Here's where the strategy gets powerful. Big firms don't focus on short-term gains. They focus on cash flow consistency. While retail investors say, "I hope my coin goes 10 times," institutions ask, "How can I earn yield whether it goes up or down?" They use hedging strategies with perpetual futures, options, and delta-neutral setups to lock in yield while minimizing risk. Let me break that down simply. Let's say they stake Ethereum to earn 4% annually. At the same time, they short ETH futures with 4 times leverage. If the price drops, their short pays off. If it rises, their stake earns yield. Either way, they win. That's how banks and funds play. It's about controlled exposure, not emotional risk. And the beauty is, you can replicate parts of this. You don't need millions to start thinking like a bank. All you need is the mindset of capital efficiency. Let's say you have $1,000 in crypto. Instead of holding it all in one coin, you could stake half in ETH for yield, borrow a small percentage of stablecoins against it, and use that to farm or DCA into Bitcoin dips. You're creating movement, rotation, and yield generation, just like a mini hedge fund would. Another secret move banks use? Collateral transformation. It's a fancy term for turning one type of asset into another while keeping your core investment intact. For example, firms lock ETH as collateral, borrow stablecoins, and then use those to buy tokenized treasury bills or other yield-bearing assets. You can do the same on-chain using tokenized real-world assets through protocols like Ondo Finance or Maple Finance. This is where crypto is headed: programmable banking. The tools that used to be hidden behind Wall Street walls are now available to anyone with an internet connection. You can become your own bank, your own fund, your own yield engine. Let's talk psychology for a second, because that's where most investors fail. Retail investors think in terms of price. Institutions think in terms of cash flow velocity. They don't care what Bitcoin's price is tomorrow. They care about how many times they can make their capital move this month. That's what keeps their portfolio alive during bear markets and exploding in bull runs. There's another layer to this: information asymmetry. Big firms have analysts studying on-chain flows, exchange reserves, and derivative positions. They know when liquidity is tightening or expanding. You can tap into the same edge using on-chain analytics tools like Nansen, DeFi, and Glassnode. These platforms show you where the smart money is moving, what tokens are being staked, and which protocols are attracting capital. Now, let's connect the dots. The hidden bank strategy has 3 pillars: yield compounding, every dollar must earn something even when idle; collateral efficiency, never let capital sit unleveraged; risk hedging, protect downside using derivatives or delta-neutral setups. That's what separates long-term wealth builders from emotional traders. Most people think crypto is a lottery, but the real winners, whether it's funds, whales, or early DeFi builders, treat it like a business. They build recurring yield systems, automate their strategies, and play the long game. Here's a mind-blowing example. Some institutional crypto desks earn more from funding rate arbitrage than from actual trading. They long spot Bitcoin, short perpetual futures, and pocket the funding difference every 8 hours. No price prediction, no hype, just pure systemized yield. And yes, you can do smaller versions of this too. Exchanges like Binance, Bybit, and Bitget let you set up similar strategies on your scale. The secret is discipline. Don't chase volatility, manage exposure, and always make your capital do more than one job. If you want to copy the banks, stop thinking like a trader and start thinking like a yield architect. Stop trying to predict the next bull run and start engineering your portfolio to make money, whether it comes tomorrow or 2 years from now. Crypto isn't just about buying coins, it's about mastering liquidity. Because when you understand how to move your capital through staking, lending, borrowing, and hedging, you're not just investing anymore. You're running your own microbank. So, the next time you hear someone say, "Banks are evil," or "institutions manipulate the market," just smile. Because now you understand how they do it. And more importantly, how you can do it too. That's the hidden bank strategy inside crypto. And the earlier you start learning it, the faster you'll move from being just another investor to becoming the one who plays the same game the giants do.